with inflation at a high was looming. It's often a sign of underlying economic stress. India could see significant foreign capital flowing into equity market, which ultimately means that there is an increase in demand for the Indian rupee. This week, all eyes are on USA's Federal Reserve. But why? The market expects that the Fed will shift from holding rates steady to cutting them, with a possible rate cut in September, followed by another one in December. UK's Bank of England has already made this move by cutting its interest rates by about 0.25%. So why does this matter? Well, historically, whenever the Fed has cut interest rates during, let's say, economic expansions or during, let's say, recessions, the stock markets have tended to perform well. But with inflation at a high was looming, there are still many who are concerned with what's going to happen. You must be wondering, as investors, will rate cuts trigger a stock market rally, or will they signal economic trouble ahead? Let's break this down in today's video. Over 95 years since 1928, there have been nearly 22 interest rate cutting cycles in the US. Here's what history has shown us. As you can see in the table, stocks have outperformed both bonds and cash in the 12 months following a rate cut, with an average real return of around 11%. Government bonds, on the other hand, have returned about 5%, with corporate bonds giving approximately 6% on average. Finally, when you look at cash, it has been the one asset class that has underperformed significantly, delivering just 2% returns in that time frame on average. As you can see in this table, the stock market performance has varied during recessions versus non-recession periods as well. Rate cuts during expansions, for instance, have fueled strong stock market returns, while recessions typically lead to sort of underperformance, a little bit of a moderate performance in the stock markets. However, we do see stronger bond resilience. So the obvious question here is, do recessions versus non-recessionary periods really play that big a role in determining the performance of the stock markets after rate cuts? Well, we looked at the last 50 years of data for the US stock markets, and here is what the history has shown us about these rate cuts. During expansionary periods, there's generally positive performance from the stock market. On the other hand, when rate cuts have happened during recessions, the initial market reaction tends to be negative, as you can see in this table. So for instance, let's talk about recessionary cuts first. In the 3 months that follow a rate cut, major indices like the S&P 500, Nasdaq have typically fallen. Although the initial reaction to rate cuts in recessions is negative, markets do tend to recover as the easing of the policy starts to take effect. After about 150 days, we often see a shift towards a positive momentum for the markets, with indices like the Nasdaq showing strong resilience. Tech stocks have in particular benefited from lower interest rates even in weaker economic environments. Now, when we look at the expansionary rate cuts that have happened, typically the story is a little different. When the Federal Reserve has cut rates during this sort of phase, equities tend to rally. Stock markets have performed much better. For example, within the first 6 months of a rate cut in an expansion, the S&P 500, for instance, has given roughly around 7% returns, and the Nasdaq has given well over 8% returns. After a year, the Nasdaq's performance jumped to nearly 25% returns on average, showcasing that this bullish sentiment that follows the expansionary rate cuts. Now, when we look at stock market performance, we also look at it in relation to what happens during these recessions. And when we look at the 22 rate cycle that we were talking about right at the beginning of the video, we saw that nearly 16 of these rate cuts that have happened when the US economy was either in a recession or was about to shortly enter a recession after the rate cuts. And while you may be thinking that recessions are harmful for stocks, data shows that stocks often still deliver positive returns, giving on average about 8% returns in recessions. Now, that is still much lower than what we see in expansionary periods, where the average return, for instance, is nearly 17%. However, what is interesting to note is that during recessions, we will typically see some sort of short-term volatility, but the long-term stock performance isn't very bad. And you can see this in the graph that we've shown below. So we've understood, how the markets have performed during these sort of rate cuts, but what happens after the rate cut? As you can see in this table, we'll go through the expansionary rate cuts and then we'll talk about the recessionary rate cuts. In the expansionary rate cut, what we can see is that, for instance, during economic expansions such as in 1989 or 1985, stock markets tend to experience smaller and shorter downturns. The average maximum drawdown during these periods is roughly around 5%, which is relatively mild and typically happens in the first month after the rate cut. In contrast, when we look at rate cuts that have happened in recessions such as during 1982 or the 2007 global financial crisis, markets often face significant and prolonged declines, which reflect the sort of ongoing economic certainty that surrounds the sort of wider economic phase. Now, the average maximum drawdown during this sort of period is typically roughly nearly 20%, and that is, we're sort of dipping into the territory of, like a bear market phenomenon. Unlike the expansionary periods, the bottom of these downturns can, however, take several months, which indicates the sort of short-term volatility and the sort of economic distress that we see during recessions. We've understood what happens during rate cuts in different economic scenarios, but a natural question you may be asking is, what if the Federal Reserve or any sort of government central bank reduces their interest rates too fast or too slow? Well, a fast cycle is typically one where 5 or more rate cuts happen in a year. A slow cycle will typically be something that has fewer than 5 cycles. And there can be non-cycles where there might be, let's say, an isolated rate cut for some sort of monetary policy change. Now, how does this impact the stock market? And we'll sort of look at the US market and look at how the S&P 500 sort of behaves in this period. Now, as you can see in the table, post World War II, the slow cycles tend to be more beneficial for the stock markets. Over a 6-month period, the average drawdown has been roughly around 5.5%, and by about 12 months, this deepens to nearly 7.4%. Slow cycles provide relative stability for equities, with smaller pullbacks compared to faster cycles. When we look at fast cycles, for instance, the typical response to recessions or financial crises is more severe. On average, stocks experience a drawdown of nearly 11% within the first 6 months, and this becomes even worse when we look at the 1-year mark, which is nearly 20 to 21%. The higher the volatility, the deeper the market corrections. This becomes quite common when the Fed is cutting rates aggressively. Basically, what all of this means is that slow cycles will lead to smaller pullbacks, smaller drawdowns, probably a more stable economic scenario and economic environment, while fast cycles can be triggered by economic crises, lead to a much larger and much stronger decline in your portfolios. If you see the Fed moving quickly with rate cuts, it's often a sign of underlying economic stress, and the markets will tend to reflect that as well. So as investors, what sectors do you think would do well in slow and fast rate cutting cycles? Well, cyclicals, which is typically industries like energy, industrials, and financials, these are most sensitive to the economic cycle. They tend to outperform in slow cutting cycles because these gradual rate cuts signal economic stability. On the other hand, defensive sectors like utilities, consumer staples, these perform much better in fast cutting cycles when the Fed is typically responding to a financial crisis or a recession, and ultimately the objective is to sort of reduce volatility in those periods. In the year leading up to the first rate cut, cyclical sectors have been represented by the blue and the black lines in the graph that you see below, and these start to underperform, particularly in the fast easing cycles as well. Meanwhile, defensive sectors have maintained more stable performance, becoming safe havens when economic uncertainty looms. Now, once the Fed has cut interest rates, the picture shifts. In the slow easing cycles, the cyclical sectors recover faster. Over the first year following the cut, as you can see in the graph, the cyclical sectors see a gain of about 4.5%, while in fast cycles, they actually tend to decline by nearly 3%. This shows that cyclical sectors thrive when the Fed takes a gradual approach to rate cuts and ultimately benefit from extended economic growth that comes with it. Naturally, the next question you would have here is the US in a recession? What are the expected rate cuts that we can see on September 18th? In the second quarter of 2024, US real GDP grew by about 3%, and this is a good sign. The Federal Reserve is projecting that this growth in GDP will continue in 2024 and to 2025 as well. Inflation we see is moderating. The Fed doesn't need to keep a very tight monetary policy, and the aim for the US Fed is ultimately to manage this inflation and ensure that the economy and the GDP of the country, of the US economy, is growing. Given these conditions, any rate cut that happened in 2024 would likely be categorized as expansionary and not necessarily a recession-driven cut. In August alone, we saw non-farm payrolls increasing by only 140,000, which is well below the expectations for the US economy. Over the last 3 months, we've also seen job growth has averaged roughly around 116,000, which is far below that sort of 2 lakh number that was typically needed to meet population growth. Because of all of these sort of different metrics that are there, future traders are actually pricing in a 35 to 55% chance of an even larger than expected interest rate cut of nearly 50 basis point by the Fed. However, this is quite extreme. Most analysts are sort of agreeing that 25 basis point cut is expected in the month of September, and this would also avoid any panic signals from the Fed for the market, since a larger cut, like we discussed earlier, could imply that the economy is in more trouble than it actually might be. Historically, these expansionary rate cuts have been followed by significant gains for equities, and I think we discussed this earlier as well, where we spoke about how in the 6 months that have occurred post a rate cut during an expansion phase, the S&P 500 has grown by about nearly 7%. The Russell 1000 grew by about 7% as well, and over a 12-month period, the Nasdaq led to nearly a 25% average return. So all this is good, but what does it mean for you as Indian stock market investors? Well, when the Fed cuts interest rates, the US Treasury yields typically become less attractive. This prompts a lot of US investors, large institutions, large funds that have a huge amounts of capital. They typically seek better returns from emerging markets, and one of them happens to be India. And India, with its high growth prospects, strong GDP, strong sort of political scenarios, could see significant foreign capital flowing into not just its equity market, but also our debt markets. As these foreign investors pour capital into Indian markets, they will also need to convert their currency into Indian rupees, which ultimately means that there is an increase in demand for the Indian rupee as well. Because of this rupee appreciation that could happen, that has two impacts fundamentally. One is that the import cost for goods for India as a whole will become much lower, but it also means that any Indian exports will become much more expensive. Ultimately, export-driven sectors could face some challenges as their products typically will become more pricier and maybe comparatively at a disadvantage compared to the global market. Now, one of the sectors that could be a strong winner from the Fed rate cut could be India's IT sector. This is a sector that has lagged in the last 1 year now. With lower borrowing costs for the US companies, corporations may see an increase in their tech spending, which could lead to more business for Indian IT companies. Firms which have heavy exposure for the US market could see their growth in order books. They could see this translating to a much stronger stock performance as well. Now, if you found this breakdown of this interest rate cut analysis helpful, don't forget to hit the subscribe button. Don't forget to like, don't forget to share the video, and do let us know if you're enjoying these videos and this analysis that we're doing at this channel. Thanks for watching, and we'll see you next time.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.